My name is Peets. I head the digital asset business for Passport Capital. This is a group of 12 individuals dedicated purely to investing kind of in the broader digital asset opportunity set. It's a relatively big team for how small the asset class is, but also even just the assets that we're managing right now. But part of that's because there's a pretty large requisite skill set, in our opinion, to invest successfully in this asset class. The capital markets and trading background is certainly helpful, but clearly expertise in open source technology and a number of other disciplines are also helpful. And so we've built a team that incorporates all of that. All right, great. So give just a little bit of background on kind of our broader investment thesis, and this is both specific to the digital asset space, but also just Passport historically. We generally believe that markets are very poor discounters of long-term secular trends, and in particular those that have no historic precedent. Broadly speaking, we think blockchain technology will be very transformational. You're going to see this impact a lot of different parts of the global economy. One of the biggest forward-leading indicators that we've been focused on, and this has been kind of irrespective of price, is just the flow of very talented people coming into this sector. That's both at the fund management level, but more importantly, experienced technologists from Apple, Google, people leaving very high-paying jobs to move into and start either working on a project or a company that's kind of directly aligned with this ecosystem. We think it'll create very large both winners and losers. And lastly, we think as institutional capital comes into this space, it's going to have a large impact on the broader market. I'll give some kind of specific metrics as to why I believe that. In terms of our own investment focus, so we're focusing in kind of the broader, like I said, digital asset ecosystem. This is directly into the underlying protocols as well as traditional equity investments in companies that are supporting the ecosystem. So that could be custody, exchanges, et cetera. We're very focused on the applications technology to capital markets, commerce, and kind of broader fintech. That's largely because of our 18 years in capital markets. That's an edge that we think that we have. And also, it's the area where I think you're going to see the fastest initial adoption. There's a lot of different applications for distributed ledger technology, but in order for those to grow and flourish, I think you need to have first, a lot of innovation as it relates to exchange, custody, and other things that are kind of more capital market oriented. And furthermore, payments is a natural element of this space. Specifically, we've taken kind of a barbell approach to investing, and that's investing into two categories within what I would call fintech would be decentralized finance or open finance, and then BetterFi, which is essentially applying this technology to existing financial applications. And I'll give specific examples. And then also I'd say that I think there's a very, you'll see strategies that tout being liquid venture, like the nature of digital assets is that they allow for the exchange of value, whether that be money, data, et cetera. So they're naturally liquid by kind of definition. But given how early we are with the adoption of this technology and the development of it, I would say that as an asset class, it's essentially a venture bet. So I wouldn't be fooled by the fact that it trades on an exchange. It's still very early in its development. And so your mindset should be, again, that more akin to a venture investment. So part of the prompt for the discussion today was just talking about the investment adoption impediments. I have in bold education understanding, because I think that's actually far and away the largest impediment. I think a lot of people don't have a good sense of the applications of the technology, the core use cases, where it's going to create value. As you mentioned in the intro, a lot of people focus on Bitcoin price, and that's what the news likes to pay attention to and the volatility associated with that. But that really misses the point of the underlying value proposition. Yes, infrastructure is important for institutional investment, custody, trading, et cetera. And there's a lot of solutions that have and or coming to market that help address that. Regulatory clarity is also important, but we've seen a lot of improvement there. And I think over the next year to 2 years, a lot of the issues that we've kind of been debating, we'll have clarity on. A more nuanced point is the refinement of crypto economic models and how these reconcile with our traditional equity models. I would argue that It's not a function of token economics, crypto economics replacing any existing model. They're really a proposal for new ways to create incentive structures that better align creators and users of these applications and this technology. And the last impediment I would say is just, in order to get adoption, and this is true for any technology, I think you really have to obfuscate the fact that you're using that or have to understand how it works. I think most people feel very comfortable using their phone or the internet and probably couldn't give you a really good explanation of how that works, and that's why it gets mass adoption, and I think that's true for cryptocurrencies as well. So agenda, so a lot of stuff I'm going to try to speed through. First, I want to give just an overview of 2017 and kind of the drivers there. I want to discuss macro tailwinds, so this is kind of social and demographic trends, as well as some market-related drivers to the digital asset space, where we're seeing fundamental adoption and the next demand drivers. And then we'll finish on some updates on the state of the market, as well as some kind of core examples of what I think the true investment case is for institutions. All right, 2017, ICOs, or initial coin offerings. So initial coin offerings were probably far and away the largest demand driver of crypto as a whole in 2017. For those who haven't spent a lot of time looking at it, you can think of these similar to an IPO in a public market. Other analogies is, people spend a lot of time talking about blockchain technology, distributed ledger technology. What is that exactly? I think a good analog is just the protocols that underpin the internet. So HTTPS, TCP/IP, voice over IP. There's several protocols that define how data is transmitted over the internet and enables a lot of different applications and companies to be built on top of. So you can think of the base protocol blockchains is similar to that. They're essentially the internet of money or data or compute, and enabling, again, data to be transmitted, but now in a completely trustless and decentralized manner. Similarly, decentralized applications which are being built on top of blockchains, such as Ethereum, are kind of akin to a .com company, right? So if Facebook.com runs on top of the internet, then you can have various decentralized apps that run on top of Ethereum. And that's really just an application that users will interact with, and there's a lot of different flavors of these, from prediction markets to gaming to a whole assortment of things. And so again, this analog with the technology to the internet is also an analog with how the market behaved in 2017 with kind of the .com bubble. And I think there are a lot of truths there, or it's a good analog to use. I think the reality is that the market, from an idea perspective, was far ahead of where the technology was, and valuations also got far ahead of where the technology was. And to use, say, Pets.com as a kind of poster child of a high-flying tech stock in the late 90s, early 2000s, it wasn't necessarily that Pets.com was a bad idea. It was just too early for its time as it relates to where the internet was, and then the required infrastructure for a business model like that to work, right? So things like last mile delivery didn't exist in the late 90s like they do today, and how Amazon uses so well. In fact, I think actually Chewy.com, which is basically Pets.com, just filed for an IPO a couple days ago. So maybe they were 20 years or 18 years too early. But the point is that while that was a high-flying stock that ultimately crashed, as did many .com companies, that wasn't indicative that the value of the internet wasn't there or the value of technology wasn't there. It was just a lot of ideas and hype that came too early. And I think that's largely what happened in 2017. But 2017 was also important because it did create awareness for the space and inspired a lot of ideas. And the idea of being able to raise capital in a purely decentralized fashion is a very important concept, and it's something that's not going away. So I think there's a lot of value that was created, independent of kind of the boom and bust. And to give some context of just the actual flows, and this actually touches a little bit on Mike's comment, because they're very, the notion of liquidity and flow is very important in this market as well. But in 2017, it was estimated that there were about 15 billion of net inflows into the digital asset space. The asset class started 2017 at 18.6 billion, but then ended the year at 600 billion, and then actually peaked a few days later in January of 18 at 813 billion. So you effectively had a multiplier effect of between 40 and 54x on the flows that came into the space. And this is important as it relates to some other points I'll make later. But to give a clear illustration of just how this frenzy for ICOs correlated with price, on the left-hand side, I have the amount in US dollars raised in initial coin offerings. On the right-hand axis, I have the price of Ethereum, and so that's the blue line. And so you can see basically the price of Ethereum tracks perfectly with the amount of capital that's being raised in ICOs. And different than traditional markets where if you buy stocks, you fund with dollars. In the case of the digital asset space, generally the funding currency would be the native currency of the protocol. So that would be ETH for Ethereum. But actually, if you looked at the Bitcoin chart in the whole space, it would look similarly. So most ICOs were being funded with Bitcoin or Ethereum, and that was a big demand driver, and also then increasing price. And we already saw what the multiplier effect was. So it doesn't really take a lot of people investing into these ICOs and limited capital to really drive the price higher. This is just some of the mega deals of 2017. So Telegram raised in excess of $1 billion. This is on a log scale. Filecoin in excess of $100 million, so on and so forth. I can say with relative certainty that probably about half of these protocols will not be something that you will recognize a few years down the road. They were taking advantage of, again, the hype associated with 2017. And the reality is that there's probably only going to be there's only probably at a base protocol level, maybe 5 to 10 protocols that will be needed. I mean, that's still kind of an active discussion. But so there's a lot of these that will be interesting ideas, but then will later be overtaken by a better protocol or better technology. This is breaking down just on a monthly basis how much of total Ethereum supply would be required to fund ICOs in that given month. And so the average amount was about 1.5% of total Ethereum would be required to fund investments. And again, I want you to keep in mind the 1.5% level because it relates to some trends that we're seeing as future demand drivers. All right. So that was kind of 2017 in a nutshell. I don't want to oversimplify it with ICOs, but that was far and away the biggest driver. There's clearly a lot of different types of both base protocols and dApp that were raising money during that environment, but that was a big driver of price. Shifting gears now towards where we see different macro tailwinds, and as I mentioned at the beginning, we're going to look at kind of some social, demographic, as well as market-related tailwinds for this space. So Nick Carter, in addition to being a co-founder of a firm called Castle Ventures, he also helped create Coinmetrics, which is a good data aggregator and data analysis site in the space. So quoting him a couple of different statistics here. But in terms of adoption by number of users, public blockchains are roughly where the internet was in 1996 and 1997, so 50 to 70 million users worldwide. And if we start looking at when different companies were created in the context of how many global internet users there were, I think it's actually quite fascinating. But when Amazon launched, there's only 7 million users of the internet globally. When Google launched, 147 million users, Facebook 817, so on and so forth. The point is that Bitcoin and digital assets in general are coming to life in the age of the internet, right? So Bitcoin, when the original white paper was published, there was about 1.7 billion internet users globally. At the end of 2013, beginning of 2014, when Ethereum came to be, the number of internet users globally had already doubled, so we were at 3 billion users. And so the point being is that everyone now is, coming into a world where everything is going to be driven, will be digital, will be on the internet, et cetera. This is social network growth, 2010 to present. So again, at the beginning of the decade, we had just about 1 billion users of social network platforms. This is anticipated to be about $3 billion in 2021. And this is a cheeky comment from another hedge fund manager. The internet would have been created faster had we had the internet. But the point is, right, is that we have GitHub and all these tools for collaboration and development. And in the context of this technology, you literally have teams that are based in Zug, Singapore, Hong Kong. There's a big base in Berlin that are constantly working, iterating, and developing these protocols. And so the speed of adoption, again, coming into a pace where internet is already well established. There's, we saw the number of users. You're going to see a much faster and more rapid, innovation in this space, as well as adoption than in, say, looking at the internet analog. Demographics, I think, also play a really, important role. This is actually, these peaks are, I guess, not the inverse of what Mike's presentation was, but this is showing as each demographic reaches essentially peak spending, that this has coincided with market tops. So this is taken from a Fundstrat piece, but basically the point was that if you can forecast market tops with about 30 years in advance if you just pay attention to when various generations are going to hit their peak spending years. Now again, this is slightly different than Mike's point, where when those go from peak spending to retiring, you might have another pillar that we should mark on this chart. But the point being is that millennials will reach peak spending in 2038. The next demographic, Gen Z, and those are the two generations that are really going to be driving market price adoption, going forward, right? So you can look at, and I didn't spend the time to add additional slides on detail with, the behavior of consumer stocks as it relates to the peak years for boomers, the behavior of internet stocks as it relates to the peak years for Gen X, but there's a high correlation towards, again, the adoption and behavior of those different sectors with the peaking of each of these generations. And I think you'll see a similar relationship as it relates to digital assets. But more specifically, or to reinforce that same point, is like kind of what is the mindset of millennials and Gen Z? And we were actually talking before this presentation some, but people trust everything, and I think millennials are probably one of the first generations that are starting to really question that assumption. Like, they grew up putting a lot of their own information on the internet, and now you're seeing kind of the trust be betrayed. Generally speaking, they also don't trust banks or the broader financial system. So again, these are just some survey results. 92% of millennials don't trust banks. US millennials prefer mobile banking. And then there's also just, where are their dollars going to be spent in the types of technology that they're going to adopt. Speaking to the previous slide, like I said, millennials' total liquid assets are going to be $7 trillion in 2020. The third quote down, and sorry to go so out of order, this is from the quarterly investment letter of a firm called Afterpay, which is an alternative lender. But it's basically insinuating that they're seeing a large trend within their user base of shifting from credit cards and other traditional banking and financing opportunities, and that's being driven largely by millennials because they want kind of more transparency and they basically trust less in the providers that they use. And then the last bullet is related to Gen Z, but Gen Z will be effectively the first native or digitally native generation. So they are the native speakers of the digital language of computers, of video games, of internet, and I would also make the argument of money. And I guess the other kind of point there is, like, you see a lot of quotes, whether it's Jamie Dimon, Warren Buffett, or other people who talk about cryptocurrency broadly speaking, but it's largely pointed at Bitcoin and Bitcoin price, and will have whatever view that they have. And the point with the demographics is that view really doesn't matter, because if this technology is going to be adopted and kind of embedded in the next two generations, like, that's going to be what's the driving force. And there's a handful of survey results talking about both awareness, but also just kind of propensity to kind of use, purchase Bitcoin, et cetera. And most of these charts are kind of, again, down into the right like this, where you're seeing, of course, a much higher propensity to use the technology and purchase for the younger demographics. All right, so the third macro tailwind I want to touch on briefly is just this broader relationship with the market. So there is this narrative that the ascension of Bitcoin is in some ways tied to effectively the kind of the easy monetary policy that we've had over the last 10 years, right? So since rates have largely been low, we've had a weak dollar, there's excess cash and liquidity in the system that enables people to take more risk. The kind of institutionalization of that comment would be that they're forced to take more risk and go out the risk curve because as whether it's treasury yields are low and credit spreads are tight, you need to generate incremental yield. And so that's part of the reason why Bitcoin saw such a large move in the last couple of years. And this is actually just from Morgan Stanley's equity strategy report just last month. And it was saying that, just to paraphrase, Bitcoin's recent participation suggests investors may be reaching for returns at this point, and we are now into the kind of speculative, i.e. very late phase of this rally. And so while I think there's maybe some merit to this, this point in this discussion, given how little institutional investment there's been in the broader asset class, I don't think there's been any way to kind of reinforce these sorts of, there's no allocator that's saying, oh, we're not generating enough yield to hit our 5% or 8% target that we have for XYZ pension fund or endowment. We're going to go ahead and buy some Bitcoin to try to generate higher yields. I don't think that hasn't been institutionalized enough to reinforce the type of relationship, but it's a narrative that's out there. And generally when you hear that narrative, it'll be presented alongside charts like this. So this is showing emerging market equities alongside the Bitcoin chart. Again, EM has largely benefited, you could say, from a weaker dollar or lower rates. Likewise, this is the kind of the same chart, but the inverse of the dollar relative to Bitcoin, again, over the last couple of years, and you see that it tracks quite quickly. But of course, if you were to look at this chart over any longer period of time, so this is back to 2012, both for EM and then for the dollar, there's very little relationship at all between Bitcoin and either of these indices. And there's a couple reasons for that. One, it wasn't in people's mind. People didn't have the familiarity that they did in 2017, back in 2012, 2013. It wasn't investable. But what I would say also is you can actually make the exact opposite argument, as that where you're seeing initial adoption of Bitcoin actually will only increase if you were to see the dollar strengthen and financial conditions tighten. So, and this is, sorry to go out of order, the institutional investment right now in Bitcoin is estimated between 4% and 7%. So this is why I was saying I don't think that relationship between other asset classes is being reinforced by institutional investment. The first killer app, so to speak, for Bitcoin that we've seen has been really in countries that you have high degree of currency instability, high degree of hyperinflation. So you read a lot about adoption in Venezuela or broader Latin America, South Africa, Zimbabwe. And so, given that's where you're seeing initial adoption, tighter financial conditions are only going to exacerbate that problem. Any country that has a high degree of dollar-denominated debt is actually going to be hurt if you have rates increase and a stronger dollar. So I'd actually, again, kind of make the argument that despite you've seen this correlation over the last couple of years, that driver is really driven by the inflow of capital into ICOs, which we discussed earlier, and that if you were to see, again, additional turmoil globally as a result of a stronger dollar, it actually would continue to increase potential adoption. And so then, again, thinking about it in terms of kind of as a traditional asset, I would describe Bitcoin as early stage tech, so kind of growth oriented. But the first couple of applications that have gotten traction have been as a store of value or digital gold or a sovereign grade censorship resistant alternative to fiat. And that's exactly what you're seeing again in countries like Venezuela. So fundamental adoption. So I just touched on this, and this is kind of reinforcing that same point that I made. This is showing the volume of local Bitcoins, which is effectively kind of a peer-to-peer exchange that takes place in a lot of different countries, normalized to USD. I forget how far this goes back, but the orange line is emerging and frontier markets aggregated. The blue line is developed markets aggregated, and then it's overlaid with the price of Bitcoin. And so what you're seeing is a kind of clear tracking on the price run up to Bitcoin, but as Bitcoin prices collapse, you've continued to see actual increase in local Bitcoin volumes in EM and frontier markets. This kind of, and I don't want to get into the details too much, but the reason why we're using local Bitcoin is that it's largely been an on-ramp for people who are buying to hold as opposed to just trading. It's not a centralized order book. It's not easy for you to get on your phone or laptop and use to trade, like you're actually going out physically and purchasing from someone. And so in terms of fundamental adoption, this is an on-ramp that's used more for that purpose than, again, going to Coinbase or some other type of exchange and just trading purely for speculative purposes. So it's not to say that part of this is not speculatively driven. Clearly it is. You can see its correlation with the price on the way up. But this compared to other liquidity venues, again, has a higher proportion that's been more fundamentally driven. And if you put in, and again, one of the biggest critiques on Bitcoin is kind of how do you value it, what's the right valuation framework, et cetera. I think there's lots of ways to think about that, and part of it is just tied to what is the use case that it's being used for. But if you think about it again as this kind of alternative store of value or alternative fiat for countries with hyperinflation, this gives you some benchmark for price. So this is, if you were to substitute Bitcoin for the narrow stock of money, M1, for the top 5 countries by inflation, you would equate to about a 12,200 price for Bitcoin. Just looking at Zimbabwe and Venezuela alone would be about an $8,360 price for Bitcoin, relative to where this was updated a couple days ago. It moves quickly, but 5,279 price today. So, I'm sure a lot of people have heard about or have heard the narrative or the pitch for Bitcoin as a store of value. A clear problem with that, right, is the volatility. So when you're in a country like Venezuela, not only are you competing against hyperinflation, so you can take and stomach a lot of volatility, but you also have to remember that the property that it's censorship resistant and that I have full control or sovereignty over my funds is equally, if not more, valuable, right? So with any cryptocurrency, I can memorize a 12-word passphrase, and I essentially can walk anywhere with complete control of all of my assets, right? I don't have to call a banker. I don't have to worry anything about capital controls, et cetera, et cetera. So even if it's highly volatile, again, if I'm in a country that has really strong capital controls or is taxing any sort of I think I would say it's like 30 or 40% tax on USD that flows into Venezuela, if that's even possible now. But so the idea that you have, again, complete control over that is something that it's probably undervalued by many of us that sit in this room, where we take for granted the stability of the dollar, access to it, the ability to have Venmo and other things that make, again, accessing our funds, using our funds easy. But it is still a problem as it relates to the adoption of Bitcoin. So what this is showing is a very cluttered chart, but 3 different axes. On the top, we have censorship resistant. So on the left, that means that it's more censorship resistant. On the right, less. The, x-axis here, y-axis would be volatility. And then on the bottom, we have centralization and less or more. So Bitcoin is, right now, very volatile, but it's the most censorship resistant and it's the least centralized. Maker is a stable coin, so it's another cryptocurrency, but aiming to be algorithmically pegged to the dollar. So it's trying to address that volatility concern, but still remain decentralized and censorship resistant. And then now we have a growing number of applications, Abra, which I'll talk about later, all the way to, say, Facebook and WhatsApp. Facebook intending to have its own digital asset, which will be backed by a basket of currencies. So I can kind of peg to a basket of G5, G10 type currencies. And so that definitely solves the volatility issue. That definitely improves accessibility, of course. If you can download Facebook Messenger, you can use their currency. But it's a very centralized company. You have Mark Zuckerberg testifying to Congress, and thus it's less censorship resistant as well, potentially. So this is kind of the trade-offs that you're making. We've seen early adoption for Bitcoin for the characteristics that it has here. Not a perfect solution, but we're now seeing a lot of other applications that are trying to improve on the volatility element. So next, demand drivers. First one I want to talk about is messaging apps. And we kind of alluded to it in the last slide. So this is headlines from New York Times not too long ago. Facebook and Telegram are hoping to succeed where Bitcoin failed. Basically, as we saw with the metrics on social network users, there's already millions of people who are on Facebook and Telegram. I think Telegram has about 250 million active monthly users. And then furthermore, at least in the case of Facebook, they're looking to peg against a traditional backup currency, so you're improving the volatility problem. So mobile messaging apps worldwide, again, this is 2016 through extrapolated through 2021, up to 2.4 billion users. And so this is one area where I think you're going to see a lot of very early adoption in the near term, i.e. probably by the end of this year, there's going to be at least Telegram, Facebook, and Signal that will already all have an embedded cryptocurrency that will enable anything from you and I sending money to each other in a Venmo style fashion to checking out with vendors, e-commerce platforms, etc. So this is again an area where back to we'll get faster adoption now that we're in a world where everyone's on a mobile phone and using the internet. Everyone's already familiar with these apps, kind of ubiquitous with using a phone, and so it will enable for very quick adoption and utilization, again, I think by the end of this year. So another demand driver, which I think is particularly interesting, is this kind of broader theme of open finance or decentralized finance. The definition here is generally true about crypto as a whole, but in the context of open finance, it's using this technology to create applications that effectively remove middlemen and the kind of tax that they put on transactions. And this is everything from remittance payments to escrow and title services. Basically anything that has a trusted third party that's charging you for that trust is something that is susceptible to disruption from the use of this technology. These are three platforms that I'll look at. Maker, again, a kind of decentralized stablecoin. Dharma is a open source protocol that enables building applications to do, again, kind of trustless peer-to-peer loans. And Compound Finance is also similar. So this is the total amount of USD that's locked in open finance applications. So basically you can think of this as collateral that's been posted in these applications that is then someone else is borrowing. So this was just over, Listra has it at 380 million. Just yesterday, this is about 412 million. If I exclude Maker and just look at platforms like Dharma, which are even more user-friendly, you're seeing, again, very strong exponential growth, even just most recently. So Dharma, for example, launched its application to the public at the beginning of April. Prior to that, it was in kind of this closed beta. But you can see just in the month of April alone, it went from about 2 million in loans outstanding to 12 million. Now, these aren't huge numbers, but if you compare them, these aren't huge numbers yet, but if there's kind of 2 points I want you to think about in terms of analogs. One was the absolute amount that was driving demand. Get outside here. In 2017, right? So we looked at this chart already. This was the ICO price of Ethereum tracking the amount of capital raised via ICOs. Again, that kind of average monthly value is about 1.5%. This is the amount of ETH that's locked as collateral in the Maker platform. Again, so to do a peer-to-peer loan, you're in most cases doing kind of an over-collateralized loan. So right now that sits about 2% of total ETH is locked inside of Maker. So we're at the same levels that we saw in 2017 on a monthly basis for ICO funding. And this is an overlay, again, of capital raised for ICOs with the total amount of capital that's sitting within these decentralized finance applications, specifically the peer-to-peer loan platforms. And so, the point being there is platforms like Ethereum and others that are acting as kind of the base protocol to enable these loan platforms, I think is one large key driver that has yet to really impact the market price as a whole. But I think probably even more importantly is putting this in the context of peer-to-peer lending markets in the US that we're probably more familiar with. So again, this was originations on decentralized finance platforms in 2018, so it's about 251 million. If we look back to Lending Club, Lending Club's total issuance from its inception in 2006 through Q1 2011 was 249 million. So basically in 1 year, Open Finance, which doesn't have any sort of centralized company, for-profit entity, have the same amount of loan originations as Lending Club did in its first 5 years of existence. In 2015, it was forecasted that peer-to-peer lending platforms would reach 30 billion by 2018. In fact, Lending Club alone had originations of 45 billion by 2018. So, Lending Club is an innovation as it relates to maybe kind of traditional lending, but it's still very limited to certain markets. It has a lot of regulatory hurdles in order to function as a business. And so now you're entering this decentralized peer-to-peer lending, which doesn't have a lot of those same inhibitors, and you're seeing growth that's far outpacing what we saw with platforms like Lending Club starting back in 2006. Again, in part because more people are familiar with these types of platforms. We have more internet users. Again, millennials, Gen Z, et cetera, might be more willingness to adopt those. But I think you're only going to see those sorts of tailwinds continue to drive adoption faster than we've seen with some kind of comps like Lending Club. The last demand driver, and I won't spend as much time on this, but is the Lightning Network. So a lot of people who, one critique of Bitcoin as a medium of exchange, it's slow, transactions are expensive, you can't use it for payments, et cetera, et cetera. So 10 years after its inception, you're now starting to see a lot of really innovative companies be built on top of the Bitcoin protocol that enable some of this functionality that was originally envisioned, so one of which is the Lightning Network. This is what they call a layer 2 payment protocol. It enables very fast transactions through trusted channels. And all that means is that basically if you have a consistent counterparty that you use or you're fine opening a channel, it allows you to route payments without writing a transaction down to the Bitcoin blockchain. So you enable high throughput without having to, again, write a lot of transactions to Bitcoin blockchain, which incurs a cost and takes a certain amount of time. The reason why I want to bring this up is I want to show two key elements. One is the growth, and also one function of how the Lightning Network works is that these channels are collateralized with Bitcoin. So as you see growth in this network, you actually take Bitcoin out of supply to enable this application. So this is a graph of early ARPANET or internet. This is showing kind of the various links across continental United States. This is showing Lightning Network in January of 2018, and this is showing Lightning Network as of today. So in 1 year, in terms of the number of channels and market participants, it's growing, again, exponentially. This is the number of nodes or participants in the network. As of April of 18, again, was 1,800, now it's 7,900. The number of channels has grown from 6,000 to 38,000. And as I mentioned, again, this is getting far into nuances, but because you have to collateralize this network with Bitcoin, this is the amount of Bitcoin that's being used as collateral in that network. And so as it continues to grow and the throughput of the network increases, it's a natural demand driver for Bitcoin. And right now there's about 1,076 Bitcoin that are locked as collateral in that network. All right, so a couple more sections. On the regulatory landscape, just one slide on this. The point is that we're seeing progress. So the framework for investment contract analysis that the SEC recently did, this is really just a way to determine if a ICO meets the criteria of an investment contract and thus a security, a la the Howey test. The Token Taxonomy Act is an act that would help clarify essentially what digital assets should be under the regulatory scrutiny of the SEC or under their jurisdiction, or other ones that should be exempt. There's been talk about kind of independent contracts or some independent classifications for commodities, currencies, and then securities. And so that would again create some exemptions for things like Bitcoin, Ethereum, et cetera. Wyoming has also been kind of pushing the envelope on creating some blue sky legislation specifically around digital custody. So they want to create a new bank charter type that would enable banks with that charter to legally custody crypto assets. So again, there's no I'd say large milestone reached yet. There's just a lot of activity going on, different legislation being proposed that I think will help resolve a lot of the current uncertainty. On the market infrastructure side, we're seeing a tremendous amount of development. So custody, there's a lot of different groups providing custody services that have now become regulated trust companies or licensed broker-dealers. And of course, you have groups like Fidelity that are entering the market and providing the same service to more traditional clients. So again, as those start getting more adoption and familiarity, I think it checks the box from a custody perspective. On trade infrastructure and lending, again, there's just a plethora of different companies that are coming to market, both new as well as incumbents that are adding services in this space that, again, will make the on-ramps for institutional investment much easier. All right, so I'm going to conclude with what I think is the investment case, investing into this space broadly speaking. First, I'll start with Bitcoin, and I'm going to go very rapid fire because this is basically an aggregation of some of the points we talked about earlier. So we are seeing fundamental adoption of Bitcoin in countries and areas who need it, right? Who need, again, an alternative store of value or a censorship-resistant alternative to fiat. Apps like Abra, which I didn't spend time talking about too much, but Abra is effectively a non-custodial wallet that allows you to custody not only crypto assets, but also give you synthetic exposure to fiat, and now synthetic exposure to anything like S&P futures or even single stocks. Again, so it's just an enabling app that's very easy to use to give you access to this market. And the reason why I included it here is that it also collateralizes all positions, all synthetic securities, with Bitcoin. So it's a demand driver for Bitcoin. We talked about Lightning Network, that there's 1,076 Bitcoin that are locked in the network now, and that's growing exponentially. On the institutional ownership side, we continue to see new all-time highs in CME volume on Bitcoin futures. We've created our own index, which is kind of a proxy for institutional ownership of Bitcoin, and this is kind of an aggregation of ETNs, the closed-end product that GBTC, the DCG runs, as well as net futures exposure, and that's at about 300,000 Bitcoin in aggregate. And so then we funnel all this into kind of a broader model that looks at how much Bitcoin is being demanded by these different sources. So again, kind of EM accumulation, Lightning Network, Abra, as well as the institutional ownership. And we look at this in the context of the actual free float of Bitcoin. So again, it's a topic all of itself, but there's a large portion of Bitcoin that is either locked or doesn't trade or is being held. And so the float of Bitcoin is quite small. And so when you start seeing these incremental drivers, it has the potential to have a very large impact on price. And we saw earlier that there was a multiplier effect of 40 to 54 for the entire asset class. And so again, we start doing kind of a bottom-up analysis on where we're seeing demand drivers, the total supply that's being pulled out, especially relative to kind of the free float, is quite substantial. So here we're seeing, an aggregate of just these sources that I mentioned in the presentation, by the end of 2020, about 16% of available supply being pulled out of the market, again, which is quite substantial. But the last section, which I think is the true rationale if I were an allocator thinking, why do I care about this space? And it's not really Bitcoin, although Bitcoin is going to be, is helping drive awareness and helping illustrate certain adoptions. But it's really all the other sectors that this technology will potentially disrupt, and why I think it's a diversifier on an ex-ante basis, right? So I've seen all these studies and reports of oh, if you had held Bitcoin for the last 5 years in your portfolio and you adjusted from a 60-40, but you added 1% of Bitcoin, your Sharpe ratio would have been X, your returns would have been Y. And that's really kind of irrelevant because one, it wasn't investable. There wasn't enough liquidity in the asset class for anyone to get true exposure. It was just kind of sitting out doing its own thing. But again, this technology applied to a lot of other business models that we all are familiar with and have exposure to is a much better kind of rationale. So we've talked about a lot of them, but remittance, payments, security issuance, brokerage, secondary markets, custody, these are all business models that are ripe for disruption, or if an incumbent chooses to defend their business model and adopt this technology, it's going to be highly deflationary on their profitability and their margins, right? So I think a lot of us, or traditional portfolios, will have exposure to Visa, potentially Dropbox in the future, a Western Union, et cetera. And so it's important to think about through this light. So I'm going to give just 2 examples to close. Terra is a company that we had invested in. It's a stable coin, but it's focused on payments. It's based in Korea. Korea is one of the markets where you're seeing the earliest adoption. About 20-something odd percent, 23% of Koreans in their 20s have already bought cryptocurrency. This team's background is in e-commerce. They're launching their pay app, which you can think of as Venmo or PayPal, on May 8th. Their integrations with e-commerce companies already has about 25 billion in GMV, or that's a collective GMV of the e-commerce companies that they're integrating with. Korea has also been more friendly from a regulatory perspective. So, this app has a fiat on-ramp with 13 of the 15 top banks in Korea. So it's easy to exchange between their token and fiat currency. And the point being is that this is just a very easy, user-friendly process, whether it's an app or checkout on an e-commerce platform. And the transaction fees will be sub 10 basis points, vis-a-vis what you would pay using Visa, Amex, et cetera. So at a minimum, it's highly deflationary on payment processors. So it's impactful to people's portfolios. And then, of course, from our perspective, we also view it as an opportunity. And then the last one that I want to touch on is a company called Figure/Provenance. So Figure is founded by Mike Cagney, who's the previous founder and CEO of SoFi. Figure at its core is a direct-to-consumer lending business. They're focused largely on HELOCs initially, so home equity loans. Provenance is a permissioned blockchain that they're also creating. Permission meaning that in order to participate on the network, they have a governance process and a board that enables you to onboard. This is largely because they're focused on, like I said, home equity loan issuance with a highly regulated market. So, I'll train a lot. So it's important. Anyways, public permissionless chains have issues enforcing governance. So using a permission chain enables them, to do that. But what they're doing through issuance is effectively kind of a carrot for participation. So since they're doing home equity loan issuance on chain, it's enticing groups like Credit Suisse is the omnibus bank, Fortress, Colchis, a lot of traditional players are coming to this as a place to first buy these home equity loans, but then we'll offer a number of other services on the platform itself. So this is custody, servicing, even rating, warehousing, and then, like I said, issuance and trading will all be done on this permission blockchain. And this just improves liquidity, reduces costs, and has a number of other kind of financial benefits. But what's important here is that they're anticipating about $3 billion of issuance in 2019. So this is happening now. This is not like we'll build it and then a few years later down the road it's going to happen, or some consortium of banks. Again, doing on-chain issuance has acted as a carrot to bring a lot of traditional players and incumbents that otherwise haven't cared about this market to the market. The fees that they'll charge for these same services is about 66% less than you would see from a traditional incumbent. And just to put that in the context of market capitalization, so this is just custodians. And so the attributable market value of custodians, so BNY, State Street, Northern Trust, et cetera, to servicing, trustee and custodial services is about $77 billion in market cap. So you're basically moving all of those sorts of again, services and operations from this disparate set of incumbents to a single permissioned chain at a fraction of the costs. And that's, again, either one of these groups will participate and it'll reduce their own margins so they can defend their business, or you'll see new businesses come in, which again will be at the detriment of companies like this. So that is conclusion. Yeah.
375 billion. Is the total?
Yeah. So as of the time, this is from their own. This looks like.
Yeah, I'm just curious. So they're estimating that when you look at all these services, if you provided these services through blockchain technology, you get $300 billion in fee reductions and $75 billion in cost savings.
So yeah, these are two different points. But right, just on the securitized products, securitization alone, they think there's $75 billion in fees that they can reduce. And then when they look at a handful of other types of operations, again, whether it's improve liquidity from shortening warehousing time to reducing financing costs to ratings to servicing fees, that's where the $300 billion number comes in.
Okay.
And then they looked at just the attributable market cap to just servicing and custodial services of the largest custodians, and that's about $77 billion of their market cap is attributed to just that function.
Gotcha.
So it's, a couple different blended points in one slide.
Right. Okay.
But the point being, it's a huge TAM. There's a lot of ability for creating efficiencies, and then you now have a company that's being led by someone who's has a very credible track record in at least building lending companies with SoFi, that's coming to market and saying, hey, this is a better solution, and I'm going to start the flywheel by doing direct lending, this HELOC product, and that's about a 6.5% yield product. So there's demand for that from a lot of different buyers as a way to get people to participate on my platform. So, yeah.
Any other questions?
Yeah.
So what is the barrier to entry? For instance, I decided I want to launch a new coin, crypto. I mean, it seems to be the value of something derives from the limited supply. But
Yeah.
if any big bank decide to issue a new crypto coin, and then where's the value of existing ones? Or what's the characteristics that you think are important for one to survive, for the other to die? For instance, what are the important features?
Sure. So, I mean, I guess the first thing is there is no barrier to entry, right? Anyone can create a new cryptocurrency. Like I can go, everything's open source, right? So I can go to like the Bitcoin repo today, I can create a copy of that, and I can create my own coin tomorrow that looks exactly like the coin does. The question is anyone going to use that? Does anyone care about that? And so part of it is, existing network effects, and that's probably what what Bitcoin has as its biggest advantage is in part that, it's well known and you have a lot of infrastructure that's, mining, kind of supporting and participating in the network. And then a lot of people who are building on top of it and adopting it because it has those security features. So it's difficult to replicate, that unless you're innovating in a way that makes, again, kind of your protocol or coin more attractive. So that's in part why there's so many different, cryptocurrencies today, is that one, it became, again, this kind of fad and craze, and so everyone was, like, good intended people were building, new innovative protocols that they thought solved a very specific problem, and there's just a bunch of other people who created something because it was an easy way to raise money. And so I think, the market correcting helps because it starts to, like, get rid of the noise and low quality projects and people focusing on, again, projects that are actually solving, a specific problem. But, aside from that, there's not a barrier to entry per se, but there is, once you have an incumbent that has network effects and being widely adopted, that becomes, the barrier to entry, for displacing, that particular coin. And then I would further add on that there's, similar to internet protocols where you have different protocols that are, for very specific purposes. So it could be file storage or, like I said, voice over IP for doing, Skype, various applications. You're going to have potentially different protocols, within the digital asset or cryptocurrency space that meet very specific needs. And so, again, this is evolving quickly. I mean, that's kind of part of investing in the space is determining, okay, well, how many protocols do we need? Who's going to win for different use cases? But something like, Filecoin is focused on distributed storage. You have other protocols on distributed compute. You have this narrative around Bitcoin around, store of value. And then you have, a bunch that are focused on payments. Again, that all have different kind of trade-offs as it relates to their throughput, their performance, but then how centralized are they, how censorship resistant are they, et cetera. So, is that, oh, yeah. Sorry. Oh, we'll start with the mic, and then we can.
Thanks, then I'll jump
Sorry.
right in. Our company comes from the traditional futures and options listed trading.
Yeah.
We do three things: prop trading, a CTA and CPO where we do managed futures, and we have a commodity pool that's a cryptocurrency index that's cap weighted,
Yeah.
and then we make markets in crypto.
Okay.
And it's growing quickly. We're becoming a little overwhelmed with this peer-to-peer stuff. But it seems like we're of the opinion, so two questions, that payments first. It feels like people are rapidly adopting ways to settle payments, and maybe it'll be Facebook coin or whatever, payments first, then the digitization of other asset classes, stocks, bonds, et cetera. So do you agree with that? And then secondly, are there a lot of venture firms focused on the whole space of crypto assets?
Sure. So to your first question, yeah, I think payments and settlement are an initial focus. And I talked about decentralized payment platforms. There's a whole other category that I didn't talk about where you're seeing kind of US dollar-backed stable coins that are sitting in like a US trust structure, right? So Gemini, Paxos, a handful of others, right, are basically putting dollars into a trust and then digitizing those dollars. And that seems a bit boring, but then when you start thinking about the different applications that it enables in terms of electronic payments or immediate settlement on a ledger, like the fact that I have a digital representation of that dollar that I know is backed, enables, again, if I want to start doing securities trades, usually you're going to settle in some currency, right? Like unlike crypto where you trade crypto to crypto, you don't usually like settle Facebook with Apple stock or something like that, right? So the first step is let's digitize US dollars. The next step, which most people, or at least some businesses are following, is actually on the commodity side, in part because security regulation around commodities is lighter. It's a little bit easier to enter. And so you're seeing now gold-backed cryptocurrencies, and then actually pretty much every sort of hard commodity is being now backed, or creating cryptocurrency that's backed by that. So then you can create, and there's a company called Paxos in New York that's focused on this specifically, but a platform that allows for trading and settlement of currencies to fiat that's done purely with one of these distributed ledgers. So I think that's happening. And then as it relates to more traditional securities, that's just going to take time. Part of it's the regulatory piece. But the last company I mentioned, Provenance, I mean, they're doing on-chain issuance of HELOCs. Those are securities. They're getting the nod of approval that they act as a qualified custodian. And so now you have this digitally native, but traditional security, which then enables a lot of kind of financial innovation, beyond that. And then, yeah, there's definitely a lot of, venture funds that are focused purely on this space. I mean, our approach is probably 80% venture, but in the kind of the broader fintech, focus. So we might do 20% investments that sit outside of the digital asset space, and kind of fall into broadly fintech. But then there's, like someone mentioned Pantera earlier, blockchain capital, a few others that are just pure venture funds that are focusing only on the digital asset space. And then again, some of them are like every single thing that's going on in the space, whereas we're more focused on capital markets and fintech. You have some sector focus as well. You have a question? No? Yeah.
Any other questions? Okay, thank you very much, Will.
All right. Thank you.